The largest household expense for most American working families is tax, greater than shelter, greater than food, greater than energy, and greater than transportation combined. So the idea that a measure of the purchasing power of the dollar doesn't include tax,
Wow.
it's 40% of the household expense of so-called middle-class households. That's pretty crazy.
Hey, welcome to this video. I've got my friend Rick Rule as a guest again. Rick, how are you doing?
The better for being on with you, Mike. Thank you.
Thanks. Okay, so just before we started this recording here, we were talking about natural interest rates and Jim Grant. I haven't kept up with this as much as I should. Everybody, I don't know if you always have this feeling, but I've always got this feeling that I'm running as fast as I can and I just cannot catch up with everything.
I guess last point first, one of the joys of being 70 now is that I don't try and keep up on all topics. I sort of ration my time and effort and pay attention to that which I either really like or I feel is really important. There was a bunch of stuff, probably for both of us, Mike, that we were in our 30s, decided was important that probably wasn't. And rationing our time, much as we would prefer that our government rationed the expenditure of our money, I think turns out to be part of the wisdom of age. I know that's not where you started the conversation but it was an interesting segue.
Yeah, well, you said the government would like us to ration our money with its currency, first of all, but they would like to take an enormous portion of it, have us ration our expenditures, but then they will not ration the expenditures of the stolen capital from us. So.
Yeah, it's an interesting point you make. I was looking in various sort of social media outlets this morning, and a couple things struck me. One was a discussion out of Canada where the person who runs the Central Mortgage and Housing Corporation of Canada admitted that the government's supposed plans to build 3.5 million houses was a lie. And I thought back about how many of these lofty goals had everything to do with being elected and maintaining faith in government, and not very much involved in the meeting of the goal. About 5 minutes later, there was, of course, a discussion about bracket creep. The fact that inflation is really a tax, as the purchasing power of your capital gains, savings, and income declines with inflation, you pay more tax and get pushed into higher rates.
Yes.
If the tax code was actually about equity, of course, these rates would be indexed to inflation. So I think we can do away with the sense that it's about anything other than the fact that the government wants the money. But the thing that really piqued my interest this morning was a discussion coming out of Jim Grant, who's one of my absolute favorite observers. I love Jim. He's the one who coined the phrase, I think, around government bonds, return-free risk.
Yes, he is.
The interest rate that's paid is so far below the purchasing power, the diminishment of the purchasing power of the security, that the 10-year bond, as an example, ultimately is a way to take a portion of your purchasing power every year for 10 years. And so there was really a lot to learn this morning in the news. I'd love to talk about any of it. It's interesting.
Back in the 80s, treasuries were called certificates of confiscation, right?
Right.
They confiscated your wealth.
Yeah. And, we've talked about this before, but maybe for the audience who hasn't listened to our conversations before, we should go through a little arithmetic. The important preamble to the arithmetic is that I don't, and I don't think you do, believe that the CPI is really a measure of inflation.
I coined the term the CP lie.
you're right up there
It's
with
in
Jim
my
Grant.
first book.
Yeah, you're right up there with Jim Grant. I mean, listen, first of all, it's hedonistically adjusted, right? Which means that a bunch of big thinkers tell you what your computer's actually worth, which is different than what you paid for it. And they tell you what your house is worth, which is different than what you paid for it. Then, of course, when it's inconvenient, they don't include food or fuel.
Yeah, a car costs less than it did back in the 80s.
Yes. Yes. Anybody who looks at me knows I like to eat. So an index which doesn't cover food and fuel is, from my point of view, strange. But the strangest thing of all, to me, is that the CPI doesn't include tax. The largest household expense for most American working families is tax, greater than shelter, greater than food, greater than energy, and greater than transportation combined. So the idea that a measure of the purchasing power of the dollar doesn't include tax,
Wow.
It's 40% of the household expense of so-called middle-class households. That's pretty crazy. So if you take that as a preamble, I did some probably inaccurate calculations about the deterioration of the purchasing power of my own savings against the basket of goods and services that I consume, mostly tax. And what I believe is that the purchasing power of my savings is declining at about 7% compounded, fully loaded. Jim Williams' shadow stats, of course, would come with a higher number, but I don't need to use a higher number to make the point. So let's get back to the arithmetic. The U.S. 10-year Treasury pays you, 4.3, I think, currently, in a currency where the purchasing power is declining at 7% compounded. That's pretty ugly math. What the government is saying is that they're going to take away 2.6% of your purchasing power a year for 10 years, a promise which I'm certain that they'll keep. But that sort of bothers me. I mean, it bothers me personally, but the truth is I've been lucky. I've worked hard. I don't have much to worry about in my life. It bothers me a lot more for younger people. It bothers me for people who don't at least understand, Mike, the nature of what's happening to them. I think it's bad economics, but I also think it's immoral. And I love the chance that you give me to talk about it.
Well, it is immoral. And most people do not most people are sort of confused and wondering what is going on. And I'm so glad that you introduced this equation into it, that you introduced tax into the equation, I should say, because I'm going to use that from now on. This is really important. I would encourage John Williams also to come up with a CPI that includes the tax brackets and the fact that, the average income is being pushed into higher and higher tax brackets all the time. When they've got inflation, not only does your dollar purchase less, but you have to ask for a raise eventually. If you're a salaried employee, you have to ask, or if you're on a wage, you have to ask for a raise and get more to be able to live the same lifestyle, except that pushes you into a higher tax bracket. So a lot more is being taken for, it's a vicious spiral and it's out of control. Does this at all seem sort of like an end game to you, the stuff that the government is doing? There is no constraint or restraint when it comes to their spending, the deficit spending and so on. It seems like they've completely lost their minds to me. And you talked about the immorality of the whole thing. So
I guess the voters have lost their mind.
The voters are uneducated, though, on how economics works. This is one of the main things. When they vote for things, they don't understand exactly. They're presented with one half of the equation, and that's what they're voting for. They don't know. They don't understand the other half of what they are voting for. And that half is, well, how are you going to pay for it?
I think you're generous with the fractions. I think that the voters are very good at feeling.
Yeah.
And they respond to narratives well. And I don't think that they're so good at arithmetic. I think the voters are probably fairly bad about thinking. Now, they can be excused for this in the sense that it's much more fun. It's much easier to feel and much more difficult to think. When the voters think about inflation, if they do think about inflation, first of all, they think about the CPI, which, as you suggest, is a lie.
Uh-huh.
The second thing about inflation is that, oddly, it benefits the rich more than anybody else. A period of low interest rates, like we went through, lower interest rates, which we went through for 40 years, and high, at least replacement cost inflation, benefited old, fat, bald, rich guys like me. I had access to credit. I had the education to understand how to apply the credit. I bought real assets, and my cost of capital was below what it would be in a normal set of circumstances. At the same time as the replacement value of the assets I bought, things like almond groves and apartment buildings increase. Ironically, these government programs, if you are clever enough to dodge them, worked out very well, but not in the way that either the politicians, I think, or the voters intended them. It's interesting to see now that Jim Grant suggests the conundrum that the natural interest rate, which is to say the interest rate which would attract private capital relative to the deterioration of the purchasing power of the dollar, is quite high. And there is some threat of a failed auction, Treasury auction, which means that from his point of view, the probability is that the nominal or false interest rate stays higher for longer than other people believe. He also says that if that doesn't occur, if there is a Fed pivot, that it will have a profound impact on faith in the market, and perhaps an impact on market liquidity. I'm not saying this is going to happen. Jim Grant is better at stuff than me. I'm just a credit analyst, not an interest rate analyst. But it really, truly is an interesting conundrum. And I think it's something that all of your listeners need to take into account with their own actions, which is the reason why I was so eager to have this discussion today.
Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. Yeah, well, I need to start reading some Jim Grant again because I haven't for a little while. But when it comes to interest rates, he probably is the expert on it. You mentioned programs that don't necessarily work. Milton Friedman used to say programs should be judged by their results, not by their intentions. And all of those voters going into the voting booths are always they're being sold a bill of goods based on intentions and you said feelings. So what happens if the natural interest rate stays high? It keeps the Fed from reducing the nominal interest rate, you're saying. So interest rates will stay higher for longer against the Federal Reserve's best judgment or their own choice. I don't know if they do have best judgment. I think that's something that escapes them. But so with interest rates higher for longer, what do you see as the result?
Well, I think it continues to do an interesting thing to the bond market if that's what occurs. There's a lot of people who are advocating buying bonds now for capital gains purposes rather than for income purposes.
Oh, hoping that the interest rate is going to fall very soon.
Yeah. I've never bought bonds for capital gains. I've always bought them for secure yield, but that's interesting. And I'm probably not smart enough actually to answer to your question in terms of what happens. My own suspicion, I remember once in conversation at dinner with Jim Grant about the delta between the natural interest rate and the manipulated interest rate. And he said that in history, private investors have demanded between 250 and 400 basis points real return. That is to say, a return above the rate of deterioration of the value of the currency. That would imply, if you agree with my ballpark assessment, that the deterioration of the dollar is clipping along at about 7%. A 300 basis point real return
10%
would
interest rates
suggest a 10% riskless interest rate. Traditionally, things like 30-year fixed mortgages have traded at 150 basis point premium to the so-called riskless rate, which would suggest a first mortgage rate in the 11.5% rate. That would certainly take care of the problem of affordable housing, Mike.
Yes, it would. So, we do have a problem in commercial real estate right now that could end up being the trigger for the next crisis. There's so many things out there that could end up being the trigger. But right now, refinancing commercial properties, there's all of these office buildings all across the country that are 50% full. They've never had vacancy rates this high. And the loans on them tend to be 5, 7, or 10 years. There is no 30-year, from my understanding, for commercial real estate, and so there's a lot of refinancing coming due. There was just a building in New York that in 2019 was sold for $65 million, and it just went for $16 million, largely because of this dynamic. The buildings are valued based on the rental income, right, not based on the actual construction materials and location and so on. It's the cash flow that comes out of the building. Is the owner going to be able to service the debt on the building? And so that's how the bank is looking at it. So all these owners, their refinancing is coming up. They have to do it. Now they've got to do it at this far higher rate. But is the bank even going to want to refinance this building if the cash flow is down to where it's suggesting that they're not going to get paid? And then if they do it, at what premium are they, over what they would, if it was a normal situation? It's already going to be, much, much higher interest rate than it would have been back in 2020, 2018, 2019. And so the premium for this extra risk that they would demand would probably put it up in the range of that 11.5% that you were just talking about. So what do you think? Interest rates higher for longer until there is some sort of giant crisis. And once we get back into crisis mode, we go back to zero instantly, right? Is that...
I'm not smart enough to tell you. I just think that it's a question that each of your listeners needs to ask themselves. And it is a question where I think it's increasingly urgent that your listeners consider in the context of their own portfolio. I mean, listen, I'm a believer that markets work. Our mutual friend, Doug Casey, once said that bear markets don't change the value of anything. They change the price. And they, in Doug's very politically incorrect fashion, he suggests that they return goods to their natural owners, from the weak and the stupid to the strong and the wise. Now, somebody who bought a building for $65 million and has to sell it for 15 or 16, the person who bought it for 65 doesn't feel so good about the transaction. The guy who bought it at 15 or 16, he probably doesn't feel so bad. And as a consequence of the cost of capital for him at the $16 million valuation, that allows rents to fall. So the tenants probably feel good about it too. It resets property tax much, much, much lower, which I think is great, but the government might not like so much. But if you think about all of this in the context of your own portfolio, that's what becomes important.
Yeah.
Think as an example, Mike, and I hope not too many of your listeners are part of this group. There's a whole generation of Americans whose thoughts of the future were generated by the last 40 years, a period that was very benign with lower interest rates. And this whole generation of Americans, among other things, has turned into what I so inelegantly call yield whores. People who buy investments based on the amount of distribution it gives them to sustain their current lifestyle. And many of these people have been lured into so-called high yield ETFs. And these high yields are obtained by taking short-term credit risks. You have these high yield ETFs that are extremely liquid and are owned in $10,000 or $20,000 chunks by middle America. The problem is that the underlying assets, over-the-counter bonds, are highly illiquid. And if we have any of the sort of constrained credit market that you describe, if we have the sort of liquidity squeeze that we had in 2008, which I don't think is unlikely, and you have middle America bailing out of these high yield funds, which are very liquid, and the fund manager trying to sell the underlying assets, which are highly illiquid. I think we described this, you and I, in a previous conversation, as owl bonds, which is to say bonds where when the portfolio manager calls the broker and says to sell, the broker says, to who? And I say this not to get your audience to laugh, but rather to consider what's in their portfolio and what assumptions went into buying it. If the whole assumption was yield, you need to wonder what the probability is that you continue to enjoy that yield in the next 10 years, where the circumstances that you're confronted with are very different than the circumstances that you were confronted with over the last 40 years. That's the point, I think, of the discussion that you and I are having.
Yeah, that's the reason I'm such a fan of monetary history, and keeping in mind, having a planning scenario in the back of your mind that fits a financial and economic model that we haven't experienced in our lifetime, that fits the Great Depression, for instance.
Right.
And then you're ready. If you've got that in the back of your mind and you sort of know how to pivot, you've rehearsed that in your head, you'll be ahead of everybody else. So, I look at all of these. When I was writing my book, I had to look at a whole bunch of different financial indicators and, the real estate bubble that we're in, the stock market bubble that we're in, the bond bubble that we're in, and trying to think of what is going to happen in the future. Now we're going into an election year. And so they want, the powers that be want everything to go as well as possible. But the pressures and the warping of the economy that has occurred, all of the pressures that have built up, to me, feel like a pressure cooker on the stove about to explode. And I don't. Do you think that the 2008 financial crisis occurred during an election year, and they weren't able to shove that off into the next year? So do you think that something could happen in 2024, or do you think they can put it off until 2025? And if it does happen with the warping that we've got, how bad do you think it'll be?
If you give a pretty good salesman like me the use of the word could, I can sell you anything. What I'd prefer that your listeners thought or thought about was, is there a probability or a strong possibility that would occur? And if there's a probability or strong possibility, is your own personal balance sheet, your portfolio, does it take that into account?
Right. Is it
How
resilient
did you
enough?
feel coming into 2008? Did you have sufficient liquidity so that when a liquidity crisis hit, you had the ability to take advantage of the situation, or were you taken advantage of by the situation? People need to look at their own portfolios. We've discussed liquidity before. People say, well, I don't want to have savings because, as you say, the interest that I earn on my savings doesn't match inflation. My suggestion to those people is that the purchasing power decline that they suffer with interest should be considered an option payment on having the liquidity to take advantage of a 2008 circumstance, rather than being taken advantage of.
Yeah, it's the different. It's taking a look at your portfolio, and if this happens, then do you want to be the victim or the victor?
Right.
Something
that people need to keep in mind, and I'm not one who says necessarily that we are going to have a liquidity crisis anytime soon. I actually personally believe there's a probability of it, but as you and I have talked about before, Doug Casey and I between us have called 17 of the last 3 declines. So I'm always concerned. I'm a credit guy, But think about this, Mike, and I hope your audience thinks about this. When we went into 2008, government debt on balance sheet, not off balance sheet, on balance sheet liabilities of the U.S. government were about 25% of GDP. In other words, the government still had the ammo to push on the string. Recourse liabilities of the government now, full recourse, which is to say on balance sheet liabilities of the U.S. government, now exceed 100% of GDP. Mm-hmm. So the necessary ability of the government to print and spend their way out of a circumstance is materially diminished. I'm not trying to say that the confidence in the U.S. economy doesn't exist to the extent that they wouldn't be able to do it, but it would be much, much, much more challenging from my point of view, just because of simple arithmetic. Debt as a percentage of GDP has quadrupled, which means that the financial flexibility has probably declined concomitantly. Now, you as a commentator and your audience, I suspect, as a consequence of them following you as a commentator, necessarily needs to include gold and precious metals related investments in the conversation. I am fond of saying I don't own gold because I think it might go from 2,000 to 2,200. I own gold because it might go to 6,000 or 7,000 or 8,000. Mm-hmm. I remember well the period 2000 to 2010. Gold at the beginning of that epoch had been written off completely, and it was selling for $250, $260 an ounce. By the end of the decade, it was selling at what, $1,850 an ounce?
Yeah.
An even more impressive statistic, I think, is that in the face of what I see as society being between the rock of higher nominal interest rates and a liquidity crisis, that the market share of gold and precious metals related assets is less than 0.5%, which is to say 0.5% of all the savings and investment assets in the United States are in precious metals or precious metals oriented assets. The 4-decade mean, according to JP Morgan Chase, is 2%. I believe in
1980 it was above 5%, wasn't it?
JP Morgan didn't have access to the statistics, but they estimated that it was between 5 and 6%. But let's throw that out as an outlier just for fun, because we don't need it for our argument.
Okay.
If precious metals reverted to mean, demand for them would quadruple. And that's precisely what I think is going to happen.
Demand versus price, that doesn't mean that the price will quadruple. If the demand quadrupled and you have a fixed amount of ounces, the ratio between demand and price is a nonlinear thing. You should see prices go up much greater than a factor of 4.
If you assume that prices are set on the margin, the margin between supply and demand, not aggregate supply and aggregate demand. What you say is true. But again, I don't need that to make my argument to your listeners. I just need to say that most Americans need to own more of it rather than less. And the consequence of that is that a price target is higher, not lower. I don't think that investors, unless they're extremely knowledgeable and extremely hardworking, should be over-invested in precious metals. Because the truth is, it's an insurance policy where a small premium buys a fairly large payoff. A circumstance where 10% of your net worth is in precious metals and precious metals related assets. If past is prologue with regards to the price performance of these assets during tough economic times, the performance of this 10% of your portfolio in precious metals will offset, if not eliminate, the deterioration that you would see in a whole host of other asset classes. And that's the argument that I'm trying to make here. If you consider physical gold itself as an insurance class and other precious metals related assets like high quality gold stocks as investments, the performance that you get out of this sector means that a fairly small proportion of your portfolio fulfills the insurance function that gold has filled for investors for 2,000 years. And that's what I'm advocating, Mike.
Okay, well, that's excellent. I believe that everybody should start a core position in precious metals. I love the liquidity of it. And then there does seem to be, at least unless we go into an extremely deflationary collapse, there seems to be this enormous support under the gold price. If it drops too much, governments come in and buy. It will be China gobbling up any excess supply. It just seems like the risk reward ratio between the potential upside for gold right now versus how much downside risk there is, and the fact that if it did go down a little bit, it's temporary, because even if there was extreme deflation, that scares the hell out of the central banks, and it would be followed by big inflation, because they have to. If there's deflation, they got to take interest rates to zero and create as much currency as possible. And we've already seen the result of them creating as much currency as they can. It goes to, the Federal Reserve Act sort of handcuffs or ties the Federal Reserve. Their wrists are tied to where they can only inflate the markets. Everything has to be purchased through a primary dealer. And so all of the new dollars that are being created by the Federal Reserve go into the financial markets, and you see the financial markets inflate, and the economy becomes warped. When they take interest rates down, it tends to inflate real estate. And so their goal will be to get out of any type of deflation, because our entire financial system, the monetary system itself, cannot withstand deflation at this point. Big deflation. And so it just seems to me that the risk reward ratio for gold, especially, more so than silver, is very, very shifted, more so than just about any other investable asset. It's shifted toward the reward, with the risk being minimized. There are buyers that will come in if the price drops. And so it seems to have this support under it. Got any comments on that?
Sure. I mean, a whole bunch of comments. I think that your description of the likely outcome of a liquidity squeeze, which is to say an incredible injection of artificial liquidity, is one that's been proven by history.
Yes.
I think that one doesn't probably use that as a crutch. I think that you need to maintain liquidity in your accounts in addition to having gold. Although, as you point out, gold is superb as a form of liquidity. It's a volatile form of liquidity. And for it to be liquidity, you have to be willing to sell it to buy a different asset class when everything else collapses.
Or borrow against it.
Yeah, or borrow against it
Right.
from me, hopefully.
Yeah.
But I want to return to the fact that it doesn't take a lot of gold. It just takes some gold to provide insurance that you're talking about. And most people don't get that. Or if they do get it, most people confuse themselves with the form that they buy gold in. As an example, although I made the money that I now invest by speculating in exploration stocks, owning a gold exploration stock is not the same as owning gold. The gold exploration stocks are looking for gold. They don't have any. And as such,
you're looking for gold. You're invested in a management team. You're invested in the honesty of the individuals that are running the company. So it isn't a direct investment in gold. You hope that they find gold, but it's basically a derivative of precious metals.
Precisely the point is that you begin your gold investing journey, the gold portion of your portfolio, by owning gold, by owning the stuff. By all means, then, once you've covered the insurance part, invest. Buy the good gold stocks. And if you're willing to work hard and take risks, and if the rest of your portfolio is covered off prudently, then by all means, speculate. Just don't confuse the three activities: insurance, investment, and speculation. That's what I'm hoping to impart to your listeners.
Yeah. Do you want to tell us about your free service of rating stocks again?
I do. If you invest in precious metal stocks or natural resources stocks, that's what I do for a living. If you think that my thoughts have value, you can personalize them. Go to ruleinvestmentmedia.com, list your natural resource stocks. Please, as I've said before, no pot stocks, no crypto. All rank your natural resource stocks absolutely for free, no obligation, 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might have value. Once again, that's ruleinvestmentmedia.com, and we will indeed rank on a no obligations basis all people's publicly quoted natural resource stock portfolios.
Okay, thanks, Rick. I always just really enjoy talking with you. And so I think this video is running a little long, and we'll talk with you next time.
People can tell us whether it went too long or not in the comments section.
Thanks.
Thank you.
See you next time. Bye.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 1-1-1. 1 1-ounce silver bar, 1 10-ounce silver bar, and 1 100-ounce silver bar. So enter today and win.